Imagine you've just sold a highly appreciated commercial property.
Oh, man. The dream, right.
Right. I mean, maybe it's a massive rental portfolio you spent like a decade building. The ink is dry, the funds have cleared, and you are popping the good champagne.
As you should be.
Exactly. You secured your equity, you won the game, and you're just ready to kick back. But when did you take that first sip? Your CPA calls.
Yeah, that's never a good call to get.
No, it's not. Because they gently remind you that you are about to be hit with a massive six-figure capital gains tax bill. And then they mention the real kicker, which is depreciation recapture.
Yeah, which is basically the hidden trapdoor of real estate investing. I mean, it's brutal.
It really is.
Okay.
Could you, for the listeners, can you just break down what that actually means in practice?
Yeah, sure. So over the years you own that property, the IRS give you tax deductions, right? They did this by assuming the physical building was slowly degrading in value.
Right, because buildings get old.
Exactly. But when you finally sell it for a massive profit, the IRS, well, they realize it didn't degrade at all.
Oh, right.
So they want a refund on all those years of tax breaks. And suddenly, they're just clawing back a massive chunk of your life's work.
It literally turns the victory lap into a total nightmare.
Completely.
Because, I mean, we all know the traditional hustle of real estate.
Yeah.
You know, fixing leaky toilets at 2 a.m., chasing down late rent, arguing with contractors. It's a grind.
It's a massive grind.
But voluntarily handing over a third of your net worth to the government simply because you wanted to stop managing tenants.
Yeah.
That just feels fundamentally wrong.
Yeah, it hurts.
So today in this deep dive, we are exploring the antidote to that exact scenario. We are digging into a highly specific legal tool that high net worth investors use to basically freeze that tax bill in its tracks.
And, crucially, escape the headaches of being an active landlord.
Right, to generate truly passive income.
Yeah, and we're pulling our insights today from a really fascinating April 2026 deep dive guide by Kara Conde.
Which is such an interesting source.
It is, because her perspective on this is very unique. She operates as a premier luxury real estate broker and investor in Indianapolis. She's been licensed since 2002.
Wow.
But her background is highly analytical. She actually holds a computer science degree from Oxford.
Oh, wait, really? From Oxford?
Yeah. And she built her own multi-million-dollar personal real estate portfolio long before she ever became a full-time broker.
Oh, so she really walks the walk.
Exactly. She understands the mathematical mechanics of wealth, obviously, but she also intimately understands the brick-and-mortar reality of managing physical property.
Yeah, the leaky toilets part. And, you know, even if you, listening right now, aren't sitting on a multi-million-dollar warehouse you need to sell, you really need to hear this.
Absolutely.
Because understanding this strategy just completely reframes how generational wealth is preserved. It's like this whole playbook hidden in plain sight.
It really is a completely different tier of wealth management.
So we are talking about something called a Delaware Statutory Trust, or a DST. Let's just get right into the mechanics of this. What is a DST fundamentally?
Well, at its core, a DST is a legally recognized trust created under Delaware law. It's a framework that actually dates back to 1988.
Okay.
And it's specifically set up to hold title to income-producing commercial real estate. But the crucial mechanism here is that the trust is structured as a grantor trust.
A grantor trust. Okay, what does that mean for the investor?
It means when an investor puts their money in, they don't buy a physical building. They buy beneficial interests, which, simply put, means they are buying fractional, undivided ownership shares of the entire trust.
Okay, let me just pause you right there.
Yeah.
Because if I'm just buying a fractional share of a real estate portfolio that's managed by some massive corporate sponsor,
Yeah.
how is a DST any different from me just logging into my brokerage account and buying stock in a publicly traded REIT?
That is the million-dollar question.
Right. Because people buy real estate investment trusts every day to get passive exposure to real estate. So what's the difference?
The difference entirely comes down to how the IRS classifies the entity. And this was all decided in a pivotal tax ruling back in 2004, which is known as Revenue Ruling 2004-86.
Okay, 2004.
Right. So if you sell a physical duplex and try to put your profits into a public REIT, the IRS says, hey, you sold physical real estate and you bought a financial security, pay your capital gains tax.
Right, because it's like buying an Apple stock.
Exactly. But in 2004, the IRS decreed that owning a beneficial interest in a properly structured DST is treated legally as direct physical ownership of the underlying real estate.
Wait, so it's like buying a pre-sliced piece of a massive corporate pie instead of having to bake and manage your own small pie.
I love that analogy, yes.
And to the IRS, my fractional paper slice of the DST is like indistinguishable from me holding the physical deed to a building.
Precisely, and that unlocks the holy grail of real estate, which is the 1031 exchange.
Oh.
Because the IRS views your DST shares as like-kind physical real estate, you can sell your apartment building, completely defer the capital gains tax, defer that nasty depreciation recapture we talked about,
Right.
and roll all of that massive equity straight into a DST.
Okay, so you get the tax shield of physical real estate, you get to pass through the depreciation to offset your new income, but you achieve total passivity.
Zero management. The professional sponsors handle absolutely everything. The leasing, the maintenance, the financing.
You just collect the monthly cash flow.
Yep.
Okay, but wait. I'm waiting for the other shoe to drop here.
There's always a catch.
Right. The IRS doesn't just hand out magic tax loopholes without stringing a massive web of conditions around them.
Yeah.
If I get all the benefits of real estate without any of the actual work, what is the catch?
The catch is control, or rather the absolute loss of it.
Oh.
Yeah. The IRS only allows this direct ownership tax status if the DST remains purely passive.
Okay. What does purely passive mean to the IRS?
It means if the trust starts acting like an active operating business, say, they start aggressively trading properties, developing land, or actively negotiating new loans, the IRS will immediately classify it as a corporation.
And then it loses that sweet tax advantage status.
Exactly. So to ensure these trusts stay entirely passive, that 2004 ruling established a set of incredibly draconian restrictions. And in the industry, they are ominously referred to as the 7 deadly sins.
The 7 deadly sins. I mean, of the IRS.
Yeah, quite dramatic for accountants.
It really is. Let's break these down, because I want to understand what a trust is legally forbidden from doing once it has my money.
Sure. So the first 2 sins are all about the capital structure. Sin number 1. No additional capital contributions are allowed once the offering is closed.
So no cash calls.
Right. If the property runs out of money, the trust cannot go back to the investors and ask for a cash injection, period.
Wow. Okay, what's the second one?
Sin number 2. No new borrowing or renegotiation of existing loans. The debt is locked in from day 1.
Wait, so the financial structure is basically like a satellite launched into a fixed orbit.
That's a great way to put it.
Once it leaves the atmosphere,
Yeah.
it is locked in. If something breaks, you can't send a repair crew up with a new loan or fresh equity.
That's the reality. And the operational rules are just as strict. So sin number 3. No material modifications to existing leases, and no entering into new leases unless a tenant goes bankrupt.
So the leases they have on day 1 are essentially the leases they must keep for the life of the trust?
Pretty much. And then sin number 4, no significant capital improvements.
Okay, define significant.
Well, the trust can fix a broken window or maintain the parking lot, but they cannot decide to build an addition, redevelop the land, or do a massive value-add renovation.
Okay, I have to challenge the logic of this because it sounds incredibly dangerous.
Let's hear it.
Okay, if I have $1 million locked in a DST that owns, let's say, a massive industrial warehouse, and a tornado rips the roof off.
Right.
Or the HVAC system just catastrophically fails.
Yeah.
A standard maintenance budget won't cover that. So if the trust is legally barred from asking me for more money and legally barred from borrowing from a bank to fix it, isn't my investment just going to zero?
If you put a risky, aging, value-add property into a DST, absolutely, it would be a financial death sentence.
Okay.
But the sponsors who build these trusts know the rules. Because they are legally stripped of their ability to react to major crises, they're forced to engineer the portfolio flawlessly on the ground before it ever launches.
Oh, I see.
This is exactly why DSTs do not buy fixer-uppers. They buy highly stabilized, institutional quality assets.
So they are buying the types of properties that fundamentally shouldn't need a new roof or a sudden influx of cash.
Yes. They heavily favor properties with absolute net leases like, think of a massive national pharmacy chain or a corporate medical facility,
Right.
where the tenant is contractually obligated to pay for literally everything, all the maintenance, insurance, and taxes.
Oh, wow. So the tenant fixes the roof.
Exactly. Or they buy brand new institutional-grade multifamily complexes that are fully covered by, like, massive builder warranties.
Okay, so the rigidity of the IRS rules actually forces the DST sponsors to adopt an intensely defensive investment strategy.
Right. The restrictions act as an extreme filter for risk.
That is fascinating. Okay, what about the final 3 sins? How do they handle the money the property actually generates.
So sin number 5 dictates that when the property is finally sold, the trustee cannot reinvest those proceeds into a new building.
They just have to give it back.
Yep. The cash has to be returned to the investors. And sin number 6 is very similar. Any excess operating cash generated by the property month to month must be distributed to the investors.
Oh, so the trust cannot hoard cash to build a war chest.
Exactly. And finally, sin number 7 is kind of the catch-all. The trust cannot engage in any operations that would classify it as an active business.
Which means the trust is really just a sterile container.
Perfectly sterile.
It buys a perfect asset, puts it on cruise control, hands all the cash directly to the investors, and touches nothing else. It's crazy how the tax code actually dictates the physical reality of what gets built and bought.
It really does, and it dictates the timeline as well.
Yeah, right, the 1031 timeline.
Because when an investor is trying to execute a 1031 exchange, they are fighting the clock. Under standard 1031 rules, from the day you sell your original property, you have exactly 45 days to identify a replacement property.
And that 45-day window, I mean, this is the primary reason investors make terrible decisions.
Oh, absolutely.
You have millions of dollars of tax liability hanging over your head. The clock is ticking. You can't find a good building in your local market.
And so you panic buy a mediocre property just to satisfy the IRS.
Which completely defeats the purpose of investing in the first place.
Right. But this is the mechanical beauty of a DST. You have 180 days total to close, but that 45-day identification window is the killer. But because the DST sponsor has already acquired the property, structured that fixed orbit debt, and prepackaged the trust, an investor can step in, identify the DST, and close a transaction in just a matter of days.
Wow. It just completely eliminates the 45-day scramble.
It does. Plus, you can dial in the exact mathematics.
What do you mean?
Well, if your CPA says you need to replace exactly $1.4 million in equity and $600,000 in debt to fully defer your taxes, you can purchase that precise fractional slice across 2 or 3 different DSTs to hit the exact penny.
Oh, that's incredibly efficient. And I guess you get geographical diversification that way, too.
Exactly.
But let's clarify who actually has access to this, because we mentioned high net worth earlier. I'm assuming this isn't a tool for someone trying to defer a $30,000 profit on a small starter home.
No, definitely not. The SEC regulates these offerings very strictly, and they are restricted exclusively to accredited investors.
Right. And in practical terms, what does that mean right now?
That means an individual must have a net worth of over $1 million, excluding their primary residence, or a sustained annual income over $200,000.
Okay.
And on top of that, the minimum investment to even get into a DST typically starts between $100,000 and $500,000.
So this really is an exclusive tier of wealth management.
Very much so.
Let's look at the current landscape then, because Condé's report focuses heavily on the realities of 2026.
Yeah, the post-rate hike era.
Right. The commercial real estate market was battered by the aggressive interest rate hikes of the mid-2020s. So how is this rigid DST structure surviving in an environment where the cost of debt just completely reset?
Well, the sponsors who survived those rate shocks basically had to adapt their fundamental math. Condé notes that the DST offerings dominating the market in 2026 are heavily emphasizing significantly lower leverage.
Okay.
So in the past, trusts might have carried 60% or maybe even 70% debt. Today, sponsors are utilizing far less debt and sometimes none at all.
Wow, zero leverage.
Yeah, to insulate the trust from interest rate volatility entirely.
That makes sense.
Yeah.
And what specific assets are these lower leverage trusts actually buying right now in 2026?
She highlights a massive shift toward resilient, necessity-based cash flow.
Like what?
Industrial warehouses remain huge because the logistics and e-commerce supply chain demand is pretty much permanent at this point.
Right.
Data centers are obviously an exploding category within DSTs due to the relentless infrastructure needs of AI. And interestingly, self-storage is incredibly popular right now.
You know, self-storage actually makes total sense in this context.
How so?
Well, if the economy booms, people buy more things and need a place to put them. If the economy shrinks, people downsize their homes and need a place to store their furniture.
Yeah, it's very recession resistant.
Plus, the leases are month to month, right? Meaning the sponsor can adjust rental rates almost instantly to keep pace with inflation, which you can't do with, like, a 10-year corporate office lease.
Spot on. It's the ultimate defensive asset. However, we should be clear. Condé's report is very upfront that this vehicle has major drawbacks.
Yeah, let's talk about the risks.
The fees involved in setting up these institutional-grade structures are immense.
Like how immense?
Well, there are upfront acquisition fees, ongoing asset management fees, and disposition fees at the back end when they sell.
Ouch.
Yeah, these heavily erode the total return compared to just owning and operating a building yourself.
Right.
Furthermore, there's the risk of the sponsor performing poorly. Because if the management team fails to attract tenants, you have absolutely zero voting rights to replace them.
And then there is the inescapable illiquidity. Right, because you mentioned earlier that the trust dictates when the property is sold.
Yes. And the hold period for a DST is generally anywhere from 5 to 10 years, and sometimes even longer.
Wow.
And because there is no established secondary market for DST shares, you cannot simply log onto an app and liquidate your position if you suddenly need cash.
Oh, so you are truly locked in.
Your capital is completely entombed in the trust until the sponsor decides to sell the underlying building.
Which raises a really interesting psychological question.
Yeah.
You're trading away control, you're paying heavy institutional fees,
Right.
and you're locking your money in a vault for a decade just to defer taxes.
Right.
For the ultra-high net worth clients Kara Conde works with, is that extreme illiquidity actually considered a bug, or is it a feature?
Oh, it is often utilized specifically as a feature.
Really?
Yeah, it functions like a financial Ulysses pact.
Ah, tie me to the mast so I don't steer to the rocks.
Exactly. These individuals have already generated massive wealth. Their primary goal is preservation, not aggressive, speculative growth.
Right, they just want to keep what they have.
If they had liquid access to millions of dollars in cash, the temptation to tinker, to try and time the stock market, or to panic sell during an economic downturn is immense.
Human nature.
Right. So locking that capital away in a 10-year DST forces discipline. It removes human emotion from the equation, quietly generating tax-deferred yield while protecting the investor from their own worst impulses.
It's basically an enforced wealth preservation strategy.
Yeah.
I want to pivot to how Kara Conde actually applies this on the ground. Because, I mean, she isn't managing a hedge fund in Manhattan. She is a luxury real estate broker in Indianapolis.
Right.
So how does an Indiana luxury broker use a national commercial trust mechanism for local clients?
She employs what is essentially a barbell strategy for wealth.
A barbell strategy. Break that down for me.
Sure. So a local client might sell a massive commercial plaza in downtown Indianapolis. Human nature often dictates sticking to what you know.
Yeah, buy what's in your backyard.
Exactly. So the investor's first instinct is to take those profits and buy another big commercial property right back in Indianapolis. But Conde specifically warns against this due to concentration risk.
Okay, because if your entire net worth is anchored to the economic fate of a single zip code, you are incredibly fragile.
Precisely. So she uses the DST as an escape hatch to diversify their footprint.
She helps them 1031 those local profits into a nationally diversified DST portfolio.
Exactly. They might own fractional shares of a data center in Virginia, a medical complex in Texas, and an industrial park in Florida.
Oh, wow.
They've geographically dispersed their risk, and they've shifted from being an active local landlord to a passive national investor.
And this is where the barbell strategy comes into focus, right?
Yep.
Because the DST portfolio is like the invisible engine hidden away in the background. It's spread across the country, heavily regulated, utterly boring, but relentlessly pumping out tax-deferred passive cash flow.
That's one side of the barbell.
Right. And then Conde helps them take that unburdened monthly cash and use it to fund the chassis, the actual luxury lifestyle.
Exactly.
They use the passive DST income to acquire exclusive off-market residential estates in highly desirable central Indiana areas, like Carmel, Geist, Zionsville, or Meridian-Kessler.
It perfectly balances the two extremes. On one side, you have highly illiquid, passive, national commercial assets quietly generating wealth.
Yeah.
On the other side, you have highly personalized, hyperlocal, luxury residential holdings that you actually get to live in and enjoy every day.
It's brilliant. You've outsourced the labor of your wealth to institutional sponsors, protecting it from the IRS while elevating your personal daily life.
It's the dream.
It really reveals the hidden playbook.
Yeah.
I mean, even if you aren't staring down a massive commercial sale right now, understanding these mechanics is vital.
Totally
It
agree.
shows you exactly how the wealthy disconnect their time from their income,
Right.
utilizing rigid tax structures to permanently trade the daily grind for institutional-grade passive cash flow.
But, executing this requires recognizing that you are building a system.
Right.
Conde emphasizes that you cannot do this alone. You need a qualified intermediary to legally handle the 1031 funds. You need a specialized tax advisor to navigate those IRS regulations.
The 7 deadly sins.
Exactly. And you need a local advisor who can analyze national DST sponsor track records while simultaneously understanding the nuances of the local luxury market.
It requires a highly coordinated team.
It does.
But before we finish, there is one final, frankly staggering detail buried in Condé's analysis that fundamentally changes the math on everything we've talked about today.
Oh, yeah. The grand finale.
Right. She briefly notes that holding a DST offers profound estate planning advantages, specifically something called a step-up in basis.
This is arguably the most powerful mechanism in the entire United States tax code.
Okay, explain this, because my mind was blown.
To understand it, you have to understand what basis is. Your basis is essentially what you originally paid for a property.
Right, so if I buy a building for $1 million, my basis is $1 million.
Yep.
If I sell it 20 years later for $10 million, I owe capital gains taxes on that $9 million in profit.
Exactly.
And that $9 million gap is what I've been using the 1031 exchange and the DST to endlessly defer and hide from the IRS.
Correct. But the tax code has a specific rule for when you pass away.
Yeah.
When you die and leave that DST to your heirs, the IRS resets the property's basis to its current market value on the day of your death.
Wait, so if I've been rolling my properties forward for decades using DSTs, deferring all those taxes, and I die when the portfolio's worth $10 million.
Yeah.
The IRS resets my heirs' starting basis to $10 million.
Yes.
So if my kids decide to sell the DST the very next day for $10 million,
There is zero profit recognized.
zero profit recognized.
Zero. Under current tax law, that enormous tax liability you spent your entire life deferring does not transfer to your children. It simply ceases to exist.
That is absolutely staggering.
It's the ultimate loophole.
You spend your whole life playing by these rigid rules, staying one step ahead of the tax man, and when you finally cross the finish line, the bill you spent decades running from just vanishes into thin air.
Poof. Gone.
So, to you listening out there, the next time you hear about the wealthy locking their money away in obscure trusts, just remember, they aren't just buying real estate. They are buying time. And if they hold out long enough, they might just beat the IRS permanently.